The Indian market is currently processing a massive corporate restructuring event. Vedanta Limited is fracturing into 5 separate publicly traded entities. During this transition, the company is building 0 new physical assets. There are no new mines, no new power plants, and no new refineries coming online. As a single consolidated entity, Legacy Vedanta Limited holds a market capitalization of $16 billion. Post-demerger market capitalization projections tell a different story. The aggregate value of the 5 divided companies is expected to reach $27 billion. This presents an immediate discrepancy. Dividing an entity does not mechanically generate $11 billion in new value. The driver of this valuation gap is a financial market effect known as the conglomerate discount. This demerger is a financial restructuring maneuver. It is engineered to force a massive market repricing of existing assets, rather than to fund an expansion of physical operations. Before the split, Vedanta operated at a scale that covered multiple industrial sectors, controlling vast metal extraction and energy production pipelines. The primary architect of this corporate structure is promoter Anil Agarwal. Agarwal's firm has a history of aggressive corporate battles and intense regulatory clashes within the Indian market. Recent high-profile bidding collisions with rival conglomerates, including Gautam Adani, brought the structural vulnerabilities of Vedanta's centralized model into sharp focus. Despite the boardroom drama, the firm's true strength remains its physical footprint in extraction and production across India. While these physical assets operate at a world-class scale, their market valuation has been chronically held back by an inefficient, centralized corporate structure. The demerger executes on a strict 1-to-1 distribution ratio for existing shareholders. Holding 1 legacy share yields 1 share in the remaining legacy Vedanta, plus shares in aluminum, power, oil and gas, and steel. While the entities multiply, the equity hierarchy remains identical. The promoter holding stays fixed at 56.38% across all 5 companies. The critical mechanism driving the valuation strategy relies on the specific calculation of the stock's free float. Vedanta's cap table is highly restrictive. Public retail exposure accounts for exactly 16.26% of the total available shares. In a restricted float environment, market liquidity is low. As institutional investors attempt to acquire the newly issued shares, even minor buying pressure causes disproportionate upward spikes in the share price. This engineered scarcity draws scrutiny from market regulators like SEBI, who monitor environments prone to rapid valuation inflation. Expanding the share count within a restricted liquidity environment is a calculated mechanic intended to drive up the total aggregate market capitalization. Institutional capital historically penalizes holding companies that combine multiple industries, a penalty known as the conglomerate discount. This penalty exists because of the friction inherent in opaque capital allocation. In a consolidated company, cash generated by a profitable sector is often used to subsidize a struggling, unrelated sector. This chart illustrates the structural shift. The old, centralized management matrix is replaced by 5 clean, pure-play verticals. This strategy, called operational siloing, creates specialized management teams, with each team bound strictly to their own isolated performance indicators. The siloing is engineered to attract specialized institutional funds. These investors demand pure-play exposure to specific commodities without the drag of cross-sector subsidies. The primary obstacle that delayed this restructuring for years was the liability sitting on the balance sheet, 48,000 crore rupees in corporate debt. The NCLT regulators withheld approval of the split until Vedanta provided an exact accounting of how this debt would be distributed. This diagram details how the central debt ledger is fractured and assigned to the newly formed units, weighted against their individual asset profiles. Distributing the liability triggers a structural risk. The central parent company's financial safety net disappears. Going forward, structurally weak divisions can no longer rely on the cash flow of profitable sister operations to service their loan payments. If a standalone unit underperforms its debt obligations in this new structure, it faces the direct threat of insolvency. While pure-play entities can isolate potential valuation upside, they simultaneously strip away corporate armor, exposing individual segments to catastrophic downside risk. We can observe how the market is repricing these individual risks by looking at the consensus valuations for the newly separated units. This image shows the massive smelting pots used in aluminum production. This unit, Vedanta Aluminium, is the crown jewel of the demerger. Producing half of India's total aluminum output, this unit carries a commanding projected face value of roughly 489 rupees per share. These are the cooling towers of a Vedanta power plant. This unit oversees an operational capacity of 4 gigawatts. The market expects Power's valuation to land between 51 and 60 rupees per share. This is a view of the refinery towers and piping at a Vedanta Oil and Gas site. This sector commands a projected face value of approximately 42 rupees per share. Here we see the heavy industrial machinery of a Vedanta steel mill. This sector, iron and steel, is the lowest valuation segment. This contrast proves the logic of the demerger. The market prices high-value commodities at a premium without a discount for lower-performing divisions. This brings the focus back to the $11 billion arbitrage play. Cap table engineering and siloing create conditions for a valuation leap, with individual pieces summing to a $27 billion total. However, this ecosystem is fragile. The lowest valued entities must support isolated debt without relying on the aluminum division to anchor their balance sheets. Hitting the aggregate $27 billion goal assumes that every newly isolated unit can survive its specific slice of the 48,000 crore liability. Corporate demergers are extreme financial maneuvers. They trade collective corporate security for individualized market valuation, forcing investors to evaluate the survival of each piece on its own standalone merits.